Kratos Defense and Security Solutions just told shareholders to fund up to $105 million of free cash flow burn this year before the production ramp shows up in margins. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Kratos gets graded and traded. So on the headline, revenue came in about 12% ahead of estimates at $458.8 million, and that's up 30% year over year, with 19% of it organic. That's a big number for a defense name their size. And on EPS, they beat by about 62%. Adjusted earnings actually doubled from 11 cents to 21 cents a share year over year. When both lines beat like that, you're looking at a real operational quarter. So on the beat itself, this earns an A. A double-digit revenue beat paired with an EPS beat over 60% is about as clean as a top and bottom line print gets. And on consistency, this also earns an A. Kratos has been stacking beats quarter after quarter, and this print just keeps that streak going. Let's talk about the positives from the report. Revenue jumped over 30% year over year to $458.8 million, and 19% of that was organic, meaning it came from the existing business, not acquisitions. That's a real growth number. And management raised the full year revenue guidance to a range of $1.75 to $1.81 billion, with adjusted EBITDA margins expected to expand about 1 percentage point this year and another percentage point in 2027. Raising guidance mid-year like that is a strong signal. Backlog grew to $2.08 billion, and the bid and proposal pipeline, which is basically the total dollar value of contracts they're actively chasing, expanded to $15 billion, up from $14.3 billion. That's their forward visibility getting bigger. Management also called out specific production ramp targets: 3,000 small jet engines in 2027 for cruise missile demand, and around 40 Valkyrie drones a year starting in 2028. Naming actual unit numbers that far out is management putting a stake in the ground. And the unmanned systems segment, which had been a drag, finally flipped to operating profitability, a $1.2 million operating profit versus a small loss a year ago. That's the piece of the business that had been dragging on the story, and it's now turning. So on profitability, this earns a B. Adjusted EPS doubled, and segment EBITDA grew 34%, but GAAP is still a small operating loss because they're investing so heavily. Real progress, just not clean yet. Now let's talk about the negatives from the report. Even with revenue growing over 30%, they posted a GAAP operating loss of $1.6 million, and GAAP EPS was flat at 2 cents. That's because they're spending heavily on stock comp, internal research, and amortization. The reported profitability is being crushed by their own investment cycle. And free cash flow was a use of about $19 million this quarter, and management is guiding to a full year use of $85 to $105 million. So they're burning cash, not generating it, for at least another 12 to 18 months. The Israeli shekel getting stronger against the dollar is squeezing margins in their microwave products business, where they have over 700 employees in Israel. That's a currency headwind management can't control, and they specifically flagged it as pressuring margins into the second half. On top of that, total investment spending this year is guided at $250 to $275 million, funding the Prometheus joint venture, rocket inventory, jet engine tooling, all of it. That's a huge chunk of money going out before the payoff shows up. And the unmanned systems book-to-bill was only 1.0 for the quarter, meaning new orders barely kept pace with revenue. Backlog in that segment actually slipped slightly. So despite the Valkyrie hype, the bookings side of drones isn't accelerating yet. On guidance, this lands at an A. They raised the full year revenue range, laid out specific production targets for 2027 and 2028, and pointed to margin expansion in both years. That's a company putting real numbers behind the story. And on red flags, I'm at a C+. The free cash flow burn and the shekel margin headwind are real, uncontrollable pressures. Not fatal, but definitely things I'm watching closely into the second half. Putting it all together, Kratos delivered exactly the kind of quarter that validates the long-term story. 19% organic growth, a raised full-year guide, and specific production commitments out into 2027 and 2028. But they're paying for that growth with real cash burn, and the shekel headwind on their Israel operations is a genuine drag. This is a company scaling faster than its cost structure, and shareholders are being asked to fund the ramp before the operating leverage shows up in reported margins. I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The $15 billion pipeline and the raised guidance tell me the story is real, so I want some exposure here. But management is guiding to a free cash flow use of $85 to $105 million this year, so I'm not chasing the stock higher. My move is selling cash-secured puts at strikes well below where it's trading, letting the fat post-earnings premium pay me to wait. I'm easing in slow and selling puts first, not buying the pop. The guidance raise gives me some downside cushion, but a free cash flow negative year is not something I want to ignore when I pick my strike. The shekel headwind on the Israel operations adds real pin risk if the broader market gets shaky, so I stay well out of the money. My strike floor is a price I'd genuinely be happy owning shares at, given the 2027 production ramp thesis I actually believe in. I'm selling puts well below the print, only at strikes I'd take assignment on. The 1.3 times book-to-bill and the backlog growing to $2.084 billion tell me the demand side of my thesis is intact. Name production targets of 3,000 jet engines in 2027 and 40 Valkyries a year by 2028 are the kind of specifics I love to hear. With guided EBITDA margin expansion of about 100 percentage points a year, my setup into the second half of 2026 and into 2027 is stronger than it was before this print. I'm holding, and the thesis is stronger than it was going into this report. Management explicitly said the second half revenue is going to be significantly higher than the first half, with expanding EBITDA margins on top of it. Fourth quarter organic growth of 19 to 31% is a real upside catalyst that could easily run over any aggressive short calls I have on. I'm widening my strikes above the post-earnings level and pushing my expirations out to capture the third quarter print, where initial 2027 guidance is expected. I'm rolling up and out, not letting my shares get called away here. The bid and proposal pipeline moved up to $15 billion from $14.3 billion, which reinforces the 12 to 24 month structural thesis I bought these leaps on. Named ramp targets in hypersonic, rocket, and jet engine production, plus 100 percentage points of EBITDA margin expansion in both 2026 and 2027 make the long-term picture clearer. If any of my leaps are deep in the money, I'd rather roll them up to free some capital than close them out and lose the multi-year exposure. I'm holding my leaps because the multi-year story got clearer, not murkier. 19.1% organic growth combined with raised full-year guidance, is exactly the kind of confirmation I need to justify averaging down here. The specific 2027 and 2028 production commitments management called out are the kind of hard numbers that back up the long thesis for me. I'm adding in pieces rather than one block, because the $85 to $105 million free cash flow used this year is a plausible near-term pressure catalyst. I'm adding methodically because the thesis got confirmed on this print. Bottom line, this print earns a B+ from me. The demand side of the story is clearly accelerating, but the cash burn and currency headwinds mean this is still a story stock you're underwriting on faith in the ramp. Thanks for watching, and I'll see you on the next one.